Hi guys, this is Erica from Gokche Capital. Now before I begin, be sure to click subscribe and turn on the notification bell. Rodney and Ashley Baltimore were in the market for their first home, but every time they found a promising lead, it was snatched up by one company. So why is a billion-dollar investment company buying up homes in suburban Tennessee? We'll find out at the end of this video. But first, whether you are looking to buy an investment property yourself or simply want to understand how large real estate companies make decisions, you should learn about the internal rate of return. And in today's video, we have a primer on this financial metric. Number 1, what is the internal rate of return in real estate? The internal rate of return, or IRR, is a metric that tells investors the average annual rate of return they have either realized or can expect to realize from a real estate investment over a period of time. It is expressed as a percentage, and the idea behind the internal rate of return is to show both profit and time in a single metric. This is to say that it shows you your potential profit while also taking into account the time value of money, or the fact that $1 today is worth more than $1 in the future. Number 2, how can real estate investors use the internal rate of return? The internal rate of return allows investors to find a clear comparison across investment opportunities by appropriately weighting cash flows that occur at different times. For most investments, the initial IRR is an estimate based on various assumptions. So it's not perfect, but it is still a valuable tool used to measure a project's potential annualized return. Number 3, what are the advantages of using the internal rate of return? The biggest advantage is that it incorporates the time value of money. This is to say that the timing of all future cash flows is considered, and each cash flow is given the appropriate weight depending on how far out in the future you expect to receive it. Another big advantage of the IRR is its simplicity. It is an easy metric to calculate. In fact, Excel will calculate it for you, and it provides a simple means by which to compare various real estate projects. Number 4, what are the disadvantages of the internal rate of return? Firstly, a higher IRR doesn't mean your project is a better investment. While the IRR does take into account your initial investment in the project, it doesn't accurately represent all potential risks. And this is because it relies on a set of assumptions which may fluctuate over time or be difficult to accurately project, like the rental rate or the occupancy rate. So it's important to understand that like any estimate, an IRR is simply a projection. The actual results that occur can vary materially from an investor's expectations. Number 5, how do you protect against the risks associated with the internal rate of return? Well, at the end of the day, the IRR is only one metric and a relatively simple one. It can be very useful if you are making a decision between 2 or more investment opportunities, but it has its limitations, so it's important to use other metrics as well. Some of these are financial, like the cash-on-cash return or the cap rate, but others may be more qualitative assessments, such as potential for delays or cost overruns, or how likely it is that the assumptions in the metrics you use may vary over time. Now let's take a look at a very simple example. Say you are looking at buying a vacant parcel of land. The acquisition price is $20,000, and you believe that in 5 years you may be able to sell it for $25,000. If you would like to calculate the IRR of this potential investment, here's what you would do. You open Excel and you make a column for each year that you will be holding the asset. In year 1, you buy the property for $20,000. So for the IRR calculation, you put in negative $20,000. It's negative because it is a cash outflow, or money you are paying. Because this is a vacant parcel of land, there are very few cash flows in the years you are holding the property. No income comes in, and you pay, say, $100 each year in taxes, which means that in year 2, 3, and 4, you have a $100 payment. That again is negative. Now in year 5, you sell the property for $25,000, and you input the $25,000 sale price as a positive number since it is cash coming back to you. Once you have all the yearly cash flow projections in place, you simply calculate the IRR using the IRR function in Excel. And you get an IRR, in this case, of 5%. This, of course, is a very simple example, but it shows you how easy it can be to calculate the initial IRR. Just keep in mind that you have to be very careful about all of your initial assumptions. But now that we've learned the basics about the internal rate of return, let's return to the Baltimores. The couple has been on the market for a number of years. They want what we all do: a single-family home in a quiet neighborhood with low crime and good schools. And this is precisely what the Nashville area promised to offer. In 2016, the couple was very close to their dream of homeownership, but their financing fell through when they were told by the Tennessee Housing Development Agency that they made too much to qualify for down payment assistance. So they decided to rent for a few years while they saved up some money. Yet in 2019, when the couple began their search again, almost all of the affordable homes were gone. Housing prices had soared, but on top of this, homes were being snatched up by a new player in the market, Progress Residential. Progress is a real estate investment company owned by Pretium Partners, a parent company backed by a number of wealthy individuals, including a Goldman executive who predicted and profited from the 2008 market collapse. The company promises annualized returns of 15 to 20%, a rate attractive enough to bring in more than $1 billion in capital. Indeed, one investor publicly disclosed that he made an IRR of 10.35% when he exited the company. Given their size and financial backing, Progress is able to acquire properties at a discount since it can move quickly, and because it is able to make bulk purchases at auctions or from companies like Zillow looking to offload bad purchases. And Progress is buying up thousands of properties a month, which is good news for investors, but sadly not for families like the Baltimores, who must now compete with Progress and other such companies as they look to buy a home. But what do you think? Do you have any thoughts on real estate returns or the residential home market? Let us know in the comments. Did you like this video? You're going to love our Gokce Land Due Diligence program. We'll make you a land due diligence expert in just 7 days. Check it out at gokcecapital.com/glad. And while you're at our website, don't forget to explore our $1 down listings at gokcecapital.com/listings. Finally, don't hesitate to reach out. You can email, call, or text, and we will respond as soon as possible. So thank you for listening, and more to come.